Big banks have delivered their Q2 earnings, and the landscape is better than expected. The higher interest rates boosted the bottom line for many large lenders, though other income streams like investment banking took a sizable hit. So what's the smart financial play for your portfolio? Jon Curran, Principal Asset Management Portfolio Manager, joining us now. So what is the smart play in light of all the results that we have received, Jon?
Well, good morning. It's great to be with you. I think the smart play here is to stay in the large, liquid, diversified banks that have a nice blend of fee and interest income in their top line. I think the results really highlight the importance of diversification, and the big banks have shown themselves to be a bright spot, and that they're resilient and they're deft handling the deposit rates amidst the higher rates.
Hey, Jon, it's Julie here. So in your portfolio, sure. Which of these do you hold the most of, or what are you adding to right now?
Well, we work on the bond side, and we look for the large liquid balance sheets, good access to funding, not just on the deposit side, but on the access to the debt markets. And one of the big surprises this year, one of the wild cards, has been the debt issuance, which last year in 2022, January saw $29 billion of debt issuance. This January is $9 billion. This quarter really is the first quarter of material bond issuance, and we've seen a lot of it. So we're looking for the banks that have durable deposit bases, but that also can access wholesale funding markets and have the investor receptivity that they do.
And Jon, then who would you be dumping in light of that when you use your investment thesis?
So I think general good diligence wins the day here when you're considering bank investments. It's really important to do your homework, know the management teams, know that they're making good underwriting decisions. There are headwinds on the horizon. The recent Fed loan officer survey did show some contraction in lending standards and lending overall, but the big banks have been very resilient in passing through some of those rates in the form of loans to their customers while lagging the increase in deposits. They can do that because they're blessed with these large deposit bases.
What about the non-big banks, Jon? We heard from some of the regionals today, and it looks like that they're holding on, by and large, they're holding on, or even in some cases growing their deposit bases. They're having to pay up to do so. Is the debt of those banks as attractive?
Well, I think you make a very good point. I think the recent results of the big banks really shows the widening gulf between the haves and the have-nots. The gigantic banks, the money center banks, which are positioned very well to withstand headwinds and any turbulence that may be coming down the pike, and the smaller regional banks. It was heartening to see some of the really large regional banks like PNC, Truist, and U.S. Bancorp come to market in June. That opened the gate for regional banks, but we haven't seen regional banks writ large be able to access the debt markets yet. So I think we need to just see a bit more earnings stability and a little bit more how firm or how well-footed their deposit bases are before we get some sense that they can persist with success like their large bank peers.
Jon, with more regulation coming down the pike, pretty
Sure.
much imminent, are you expecting to see more consolidation? And who do you see kind of in the, like we saw JP Morgan Chase getting bigger recently because of that
Sure.
consolidation? Who do you see being a target in that situation?
It's an excellent question to see where the next tie-ups will occur. I think you have to look for symbiotic deposit footprints that are complementary in nature. You did see the 2019 merger between BB&T and SunTrust that formed Truist. To have a transformational merger like that might make sense, but it will depend on where the deposit concentrations are the largest. But I think clearly the large banks have shown themselves to be ones that can persevere through this environment. So the larger the banks, the more levers they have to pull, both in their top line and their funding businesses. And just if you look at their concentration risks, I mean, commercial real estate is one of the headwinds out there for these banks, but the large money center banks are much more insulated, not impervious, but more insulated than their smaller peers.
What about just the general headwind as well from decrease in lending demand, sort of across the board, whether we're talking about businesses or individuals?
Mm-hmm. Yeah, I mean, we did see the contraction in some commercial and industrial, as we like to call it in the industry, C&I lending, the recent Fed loan officer survey. I think that's clearly one of the headwinds that we've noted that's on the horizon. Nonetheless, JP Morgan and Wells Fargo did say that their earnings they expect to make from loans is increasing. So it's a bit of a, on the one hand, there is probably some contraction ahead and some credit tightening, but on the other hand, there is still demand. Citigroup actually posted a surprisingly large jump in their credit card revenues, and they're the bellwether. The one thing you have to worry about or just be cautious about is if the more borrowing that occurs on plastic, the more the banks have in terms of their loans. So that's one thing we're watching, keeping a watchful eye on.
Yeah, and indeed, we're seeing the provisioning for that kind of stuff start to creep back up once again. Jon, thanks for your perspective. Jon Curran, Principal Asset Management Portfolio Manager. Appreciate it.